The madness goes on. You may have heard a lot about the 2008 financial crisis if you follow the stock market. For more than 80 years, the federal government has supported mortgage lending through a number of programs, initiatives, and institutions. The assistance allowed millions of middle-class families to buy homes. The housing bubble that started the financial crisis in 2008 was fueled by cheap credit and lax lending regulations. But when the bubble burst, the banks were left holding worthless investments in subprime mortgages totaling trillions of dollars. Following the Great Recession, many people lost their homes, financial assets, and means of support. The stock markets have dropped by almost 50% as a result of the current global crisis, making it the worst since the Great Depression. The main cause of this was that, with the exception of Michael Burry, everyone at the time thought that the housing market could never collapse. How did the crisis begin then? Years of historically low interest rates and loose lending regulations contributed to a housing bubble in the United States and elsewhere, which set the stage for the financial crisis. Things started out well, as usual. In response to the bubble crisis and a string of corporate accounting scandals, the Federal Reserve lowered the federal funds rate to 6.5% in May 2000 to 1% in June 2003. The economy was intended to be encouraged by providing consumers and businesses with money at low cost. The mortgage rates started to rise. Homeownership eventually reached its limit. In June 2004, the Federal Reserve started raising interest rates. The rate peaked at 5.25% 2 years later and persisted there until August 2007. In the end, it caused a financial and economic catastrophe that cost many common people their jobs, money, or homes, or occasionally all three, as well as their livelihoods. In addition, the majority of the American homeowners discovered that their mortgage debt exceeded the value of their homes. Trillions of dollars were lost during the global mortgage crisis of 2008, but Michael Burry benefited immensely from the collapse. He not only foresaw the calamity, but he also made arrangements for himself to profit from the end of the world. So, how did Michael Burry know this and take a big risk against the domestic American market? Michael Burry, a physician who made the move to investing, considers Warren Buffett and Benjamin Graham to be his mentors and identifies as a value investor. He started a hedge fund called Scion Capital in 2000. In 2005, he started focusing on the subprime sector. He began attempting to warn his clients about the terrible crisis in 2005 after carefully reviewing the mortgage lending strategies utilized in 2003 and 2004. Burry predicted that in 2007, the housing bubble would burst. This brings us to a crash that will soon happen. His research indicates that when the actual rates are replaced with considerably higher ones, subprime mortgages, particularly those with lower rates, and the bonds based on them, will lose value. In order to short the market, he persuaded major financial institutions to sell him CDSs on dangerous subprime deals. In a CDS, the CDS seller guarantees to pay the buyer compensation if the debt defaults. Essentially, it involves getting insurance against asset default. Everyone at the time made fun of Burry. Nevertheless, Burry was able to see what other people chose not to. The housing bubble was intended to boost the economy by decreasing the cost of borrowing for individuals and businesses. Home prices started to climb quickly as a result of borrowers taking advantage of the low mortgage rates. Even some high-risk appliances, those with poor credit histories or none at all, might be able to realize their dream of home ownership. In order to create what they claim to be low-risk financial instruments, such as mortgage-backed securities and collateralized debt obligations, or CDOs, the Wall Street banks bought the loans the banks had sold to them. A sizable secondary industry for creating and selling subprime loans soon emerged. How did Michael Burry predict the crisis in light of this? Burry observed that subprime borrowers were receiving mortgages at an increasing rate in 2003. This was the initial cautionary notice. Subprime borrowers present a higher risk to lenders. Their credit scores are lower, thus, loans given to them are seen to be dangerous. These dangerous loans were then combined. Later, they were made available on the market as mortgage-backed securities. Bonds backed by mortgages and other real estate loans are known as MBSs, or mortgage-backed securities. Burry saw an opening and decided to gamble. He became more certain of this impending collapse by 2005 and, using the credit default swap he had created as a financial derivative instrument, had shorted the housing market. Burry had to pay a premium, since doing so protected him from having to make a payout in the event of the housing market starting to tank. The earnings his company was making were initially impacted by the premiums he was paying. Due to some investors' demands that their capital be removed because they were afraid of his estimates, he experienced investor revolt. Later, in 2007, the crisis started to take shape just as Burry had predicted. On his bet against the housing market, he won $100 million, while his investors pocketed $700 million. As millions of borrowers with low salaries and little assets used a lot of leverage to buy homes, he saw the subprime market's vulnerability. It was typical practice for people to avoid making a down payment on mortgages they couldn't afford when interest rates eventually increased. This raises the question of how the crisis was influenced by the laziness of the credit rating companies. Credit rating companies, according to Burry, were careless and would suffer greatly as a result. Agencies rated the riskiest 20% of the securities with a BBB or investment-grade rating and the safest 80% with a AAA rating. Michael found that 20% of securities, while being so-called subprime structures, are linked to interest-only mortgages, while 50 to 70% were linked to cash-out refinancing, and homeowners swapped their mortgages for larger ones. And last, between 30 and 40% of the impacted borrowers had FICO credit scores below 600. He thought that 15 to 25% of mortgages had LTVs of 90% or more. He continued to say that 40% of loans had second liens. Another debt will be repaid first if the borrower declares bankruptcy. Spreads on BBB securities were 150 BPS as opposed to 300 BPS from the prior year. This shows that investors did not think these assets needed to be saved. Burry's contrarian wager allowed him to finally cash in for millions of dollars. Burry won money by placing numerous bets against the odds. His hedge fund Scion Capital expanded by 55% in 2001, the same year that the S&P 500 dropped by 11.88%. Making contrarian bets allowed for these remarkable profits. The next year, at the height of the internet bubble, he shorted pricey tech stocks. His hedge fund increased its gains by 16%, while the S&P 500 fell by 22.1%. In 2003, the S&P 500 saw a return of 28.69%, making it a stellar year for the stock market. Numerous Americans suffered greatly as a result of this. Their home's original value had been somewhat diminished. They couldn't sell their homes since they had debts to their lenders. If they had mortgages with adjustable rates, their costs would rise as the value of their homes dropped. The most defenseless subprime borrowers had to keep making payments on mortgages that they couldn't afford. Scion Capital, a hedge fund run by Michael Burry, has again surpassed the market by 50%. When the housing market crashed in the late 2007, the head of Scion Assessment Management admitted to New York Magazine that he had recurring nightmares about an airplane crashing. In an interview, he claimed that although he knew what was going on, neither he nor anybody else could stop it. Burry went on to add that he was too shaken by the tragedy on December 31, 2007 to leave work and visit his family at home. The U.S. government released data suggesting that sales of new single-family homes decreased by roughly 17% month-over-month to 591,000 units in April, which was significantly lower than the consensus predicted of 750,000 units, he tweeted shortly after. Additionally, the S&P 500 index, the industry standard, dropped as much as 2.5% on Tuesday and finished the year 18 points lower. The heavily tech-weighted Nasdaq fell as much as 3.8% and has now lost 29% of its value for the year. Does this suggest that a fresh disaster is about to occur? Burry soon had his opportunity at fame, and The Big Short, a movie about how he correctly forecast the housing market catastrophe in 2007 and 2008 and made a fortune doing it, was inspired by his life. He regularly draws comparisons between his fame-making bubble and the increase in asset values brought on by the COVID-19 pandemic. For his recent prediction that the stock market would soon reach historical low levels, Michael Burry attracted attention. Recently, he claimed that the current recession might be even worse than the one that started in 2008. But what do you think? Do you think Burry has a point?